Thank you for joining us for our live webinar on Singapore Stocks in Focus, Year-to-Date Review and Outlook. This is Eric Lee. I am Sales Director with Philip Nova. If there are some technical issues with the app, you can't hear me now, you can type in help into the question box and my colleague will assist you. Also, during the webinar, if you have any questions, do type them into the question box and I will address them during the Q&A session at the end of the webinar. Please find included the disclaimer for tonight's session. Do note that the information provided today is for education purpose only. A quick introduction of myself before we begin. As mentioned, I'm a sales director from Philip Nova. I joined Philip in 2004, have more than 20 years of experience investing in the financial markets. Apart from servicing and advising my clients on investment-related matters, I also spend a lot of my time researching the markets, covering all angles such as financial analysis, chart analysis, market cycles, as well as intermarket analysis, all in the bid to improve our edge in investing and also sharing these ideas with my friends. The products I service my clients include stocks, futures, forex, and other advisory services as well. This is the presentation scope for today. If you have any questions, do type them into the question box and I'll address them during the Q&A session at the end. Okay, without further ado, let's start. Every time whenever we start to do an investment, whether it be it in stocks or in the general market, we would always like to know what is market doing, what's the general outlook, and how the market, how the economy, how the stock actually make its earnings, how they grow their funds, how they bring in receipts, how they grow their sales. Because this will likely be able to influence the trend that the market, the stocks, or the economy will head towards, the different policies that will be implemented. So for economy-wise, a very common metrics used is the nominal GDP. GDP is basically the total value of all goods and services produced in a given period of time, less the value of those made during the production process. So GDP stands for gross domestic products. Very commonly, whenever we compare the strength of the economy between countries, basically whether is it economies or like general public, like people like you and I, we typically look at the GDP numbers for a gauge. So the chart here shows the Singapore GDP from 1999 to 2023. Typically, we can see that the Singapore GDP is on an upward trajectory. There's a period of time whereby there's a short, either going flat or a short retracement. And typically, the retracement period is what we will call as recession. So this dip here is what we are all familiar with, which is during the 2020 COVID crisis, whereby the whole world economy basically shut down. So ever since then, Singapore economy has recovered and heading up to new high. But apart from GDP, one other numbers that people like to look at is the GDP per capita adjusted for the purchasing power. Because if we just were to compare GDP alone, then Singapore being a very small country, our GDP can never be strong, right, as compared to other countries with a larger population, with a larger market force. Thereby, by measuring GDP per capita, we are basically taking the GDP number divided by the population numbers. So this will actually give an idea of whether this country is doing well as on a per citizen basis. So we can see that since 1999 to current 2023, as of the last reported GDP number, similarly, Singapore economy has been growing stronger, and similarly, whenever there's a period of time when there's a recession, you will see a dip in this GDP per capita number. And understanding this is important because generally this is a period of time whereby there's a dip, then government will come in to implement policies to sort of improve the economy and improve the livelihood. As you can see, maybe I just don't mind. Let me just go back. As you can see from the numbers shown, the chart shown here on the GDP per capita adjusted for the purchasing power, meaning that factoring inflation, we see that there's a dip here in 2023 compared to the numbers in 2022. So even though GDP-wise, Singapore had grew slightly in 2023, but after adjusting for the inflation, there's actually a dip. So as such, we can see that that's the reason why government's concerned about inflation, and they are doing their best, right, to resolve that issue, because by doing that, you also help the GDP per capita to be on the upward growth trajectory again. Okay, so now let's just look at the performance of the various sector in this GDP-wise. Okay, so this is GDP on the Singapore from the construction sector. From okay, this is the only chart that I'm showing in from 1975 to 2023 because I would like you to see the very obvious cycle that is shown, that can be spotted here on this construction sector. And this is probably give me a minute. Okay, so this is probably one of the probably the only sector that has a very obvious cyclical factor that is factoring or affecting how this sector moves, and the cycle is pretty deep, right? So we all know that there's some properties that move in certain cycles. So these are therefore being affected into the construction sector as well. Okay, so this is a zoom in look in the construction sector from 1999 to second quarter of 2024. So it is very badly affected during the COVID crisis, but also had a very swift recovery from the various government sectors. So it's from the various government's policies support, and as well as the world actually recover from the this COVID pandemic. So since then, we can see that this sector has been growing gradually. It hasn't really breached the all-time high that it hit in 2015 yet. So, but as of now, this sector has a slight growth. Okay, the next sector we look at is the manufacturing sector. Okay, manufacturing sector, we can see that there's some cycle built into it, but the cycle is not as deep as what the construction cycle is. It basically roughly can be deemed as moving within this upward trending channel. We can see that since 2022 and also until now, the manufacturing sector hasn't been doing pretty great. It's actually doing a little bit of correction now. So in economics terms, we can say that this sector is basically experienced some recession, even though generally the Singapore for the whole entire Singapore economy wise, we clock in a minor growth, but this manufacturing sector is actually experiencing some sectorial recession at the moment. So this does give us a sense then, of course, when it comes to investment, because stocks or companies that are in these sectors will tend not to do well. So typically, for the stocks listed in Singapore that's in the manufacturing sectors, we know there are like the Venture and AEM, Franken, um, UMS. So these are the one of the few, just to name. And for those who follow the Singapore stock market, you are also aware that most of these stocks, they are not performing as well compared to the other stocks in the Singapore market. Okay, next is the service sector. Service sector is more, as in the upward trajectory is more smooth. So basically from 1999 to now, it's been growing. Period of time whereby there's some slowdown and sideways movement, but most of all, other than that, they are quite on an upward trend. So, and also last year, this is the sector that is performing well. Transport sector as well, affected by the COVID. You can see the sharp drop down. And the transport sector, of course, is dominated by the Singapore Airline, as well as perhaps ComfortDelGro and SPS Bus Transit. But when it comes to stocks that we invest in, basically very few people really invest in this SPS Transit. So more or less, stocks that we pay attention to when it comes to this transport sector will be the Singapore Airline and ComfortDelGro, right? So after experiencing this sharp drop, basically the sector has been improving ever since. Okay, lastly is the utility sector. So also similarly as service sector, this sector has been pretty gentle growth, and last year it did quite well. So for stocks in this sector will be like Capicorp, this Semcorp, mostly. Okay, so but how exactly good is these economic indicators for us as investors, as traders, to use in analyzing our stock market and also in forecasting the growth of the Singapore stocks, right? So I'm just going to share with you some of my views and some of the economic indicators that I use to give me an idea of how our Singapore economy is going, and also give me sort of offer some forecasting properties in view of what is coming up next. Okay, so a lot of this information are public information. You can get actually Singapore. This uh, public sector is pretty good. You can go to singstat.gov.sg, and a lot of the information, or whether mti.gov.sg, a lot of the information like shown here are available there. It does has a very nice infographics for us to look at and to have a better understanding of how our economy is heading on. So basically, this is the Singapore economy in terms of GDP numbers. Sing dollar value-wise is 673 billion, right? So, but for most public information that we go to when we search for GDP, most of them, especially those foreign or US-based website, they will usually show the GDP in US dollar, which is good for comparison when we are comparing the economies of various countries. So Singapore-wise, US dollar wise for the GDP is about US 500 billion. Okay, so this is a chart showing the GDP, Singapore real GDP from 1999 until now. So basically, just by looking at this chart alone, you can't really sieve out much information, um, or is really not of much use when it comes to analyzing the stock market. So I'm just going to show you later a few more slides on what we can do to improve this. So basically, from here, we can see that since last year until now, the Singapore economy has grown by 3%. Okay. So most importantly, whenever we look at these economic numbers, for us as investors, we want to be able to make use of it to be able to make investment decision. So from here, what we can see is that the Singapore economy is growing, but as compared to the Straits Times Index, right? We can't really find much useful information by just using this chart alone. So what I'm going to do next is to look at the annual growth rate. So the green line at the bottom is the GDP in terms of its annual growth rate. So the annual growth rate for the GDP for last year is 3%. So we can see that in 2020, during the COVID crisis, there's a contraction and then it went to recession. Okay, the GDP has gone into the negative territory. The growth rate has gone into negative territory. Then, because of the various government policies and also because of the world gradually get out of the pandemic, the GDP then starts growing, get back into the positive territory, and in fact, it spiked up with a very huge growth within a 1 year time period. Right, and this is uh, useful information in the sense that whenever you see that the GDP gone to the negative territory, or rather the GDP growth gone to the negative territory, GDP growth gone to a negative territory, then there will be a spike up flowing up next, right? And also we see the similar spike up in the Straits Times Index. Okay, perhaps this is a better chart to look at by laying the GDP growth chart side by side with the Straits Times Index. So the GDP growth rate is the line in green. The Straits Times Index is the line in black. So you can see every time the GDP dropped to the negative, the growth rate dropped to the negative territory. It dropped to the negative territory when it's going below the dotted horizontal line here. And also here, whereby it dropped to the negative territory, then it's followed by a sharp growth, and followed by the sharp rise in the Straits Times Index, sharp rise in the Straits Times Index, as well over here, sharp rise in the Straits Times Index. So of course, this tells us one thing is that it's not all bad news, right? When the economy goes into a recession, right? One of the primary reasons is, of course, government policy, right? That's when the period of time whereby the government will step in to implement policy to get the economy to start growing again. So all these policy, be it like, of course, in Singapore context, our government do not really adjust the interest rate. We basically tag our interest rate to the U.S. Federal Reserve. But our basically for Singapore is a very globalized economy, and our economic growth and our recessions more or less very much follows what the US is experiencing. So during this period of time, when the US government, or rather the US Federal Reserve, lower the interest rate or implement various quantitative easing policy, this will also have a positive impact on our Singapore economy as well. But beyond that, our Singapore government will also start spending money, all right, start getting into expansionary budget, right? Like what I mean, the most obvious period of time we can experience is during the COVID crisis period, whereby our then finance minister, Heng Swee Keat, has to implement various emergency budget, and whereby they will start spending to support the economy, support the businesses, and to get the economy to grow again, right? So, but beyond just the GDP alone, right? Because we can see that the GDP, even though is good, in the sense that we now know that when it gets into recession, negative growth, the next step is for the um, economy to start growing, for the stock index to start rising. But what if there's another indicator that can give us an earlier indication, meaning that don't wait for the recession to happen, but before the recession happen, we already are being alerted about the market top, or rather the economy top or bigger economy bottom to come. So that actually can be found by looking at these two indicators. One is called the composite coincident indicators. The other one is called the composite leading indicators. Actually, the Singapore government had actually done a research on this, comparing these two indicators, because these two indicators is far encompassing. They do not just look at the GDP alone. They look at the various factors, for especially these composite leading indicators. It looks at actually 7 to 8 metrics to determine uh, um, to determine an index that will give us an early warning system uh, to to know that when the market, or when the economic top, or when the economic bottom will happen a few months beforehand. Okay, so the shaded portion here is a period of time whereby Singapore economy enter into recession. So this recession could be caused by various factors like the European debt crisis, China slowdown, and also the recent years, the China-US trade war and the COVID-19 pandemic. So we can see that this GDP peaks and then start dropping, and then after that over here, that's when they start to grow again. So this period of time is when the economy enters into recession. So this is a comparison of the two indicators I mentioned to you that Singapore government had so-called developed to give them an early warning system. So by comparing these two, I want you to pay attention to the green line, CLI, which is the leading indicator. You can see that the leading indicator actually peaked earlier, much earlier before the economy entered into a recession. So, like for example, during the European debt crisis, CLI peaked 3 months before the economy entered into recession. And during the China slowdown, it peaked 7 months before. Then, of course, during this period, this COVID-19 and the China trade war, it peaked much earlier, and in fact, it's too earlier to be of any significant use. But out of the three recession, at least it's able to give us an early warning system about 3 to 7 months or 3 to 6 months prior to the economic peak and bottom. But this is in comparison with the GDP, in comparison with the economic peak and economic top, economic bottom. So how is this useful when it comes to share investing? Okay, so then next, what we do is that we're going to compare this indicator, the Singapore Composite Leading Indicator, with the STI. So over here, you can see that similarly as the GDP, right? This indicator is upward trending, but it has a little bit more wave, right, than the GDP. GDP is pretty much flat and then upward trending. So this gives us a pretty useful glimpse, but we can improve this. We can improve this indicator further by detrending it. So we can detrend the indicator such that we make it into an oscillation. So detrending means that we remove the trend factor and just look at the up move and the down move of this indicator. So by detrending it, we can you can almost use this uh, uh, like a technical indicator, like such as RSI, such as stochastic, right? It falls within the range of 0 to 100. So similarly, in how we use this charting indicator, when it falls into the bottom region, this is when we call it a buy zone. When it goes to the top region, we call it the sell zone. Okay, but personally I find that this indicator can pick up the buy zone much better than it can pick up the sell zone. That is because typically when the economy is growing, government will not step in to try to do something to sabotage it, to make it, to stop the economy from growing. But on the other hand, when the economy is slowing down, when the economy gets into recession, the government is more proactive in coming up with policies to get the economic engine to start again. So thereby, this indicator, you can find that it works much better in picking out buy point. Okay, this is a better look of the indicator when we lay side by side together with the Straits Times Index. So we can see that whenever this composite leading indicator falls into the buy zone, which is below the green color horizontal line, right, then it is followed by the Straits Times Index moving up. Over here, similarly, if in 2009 it falls to the buy zone, then it followed by the Straits Times Index going higher. Similarly, in 2016, falls into the buy zone. Straits Times Index, even though at that time is not at a very low point, but it does experience some correction of roughly about 12 to 15%. So we can see then followed by the STI going up again. And then again in 2020, and STI rebounded. So now we are at this region, right? Just early this year, I shared this index before on another webinar. And at that point in time, I say that that it is very likely that we're going to see a bull market for the Singapore market, just purely based on this indicator, because typically this alerts us that the economy is slowing down and the government will likely come out with various measures to try to get the engine cranking again. So it does have a positive effect on the stock market. So you can see that it need not be that the index or the stocks must trade at a very low price before the effect of this indicator will kick in, or to give the price of the stock index a boost. So apart from this composite leading indicator, there's also another indicator that we can pay attention to that can give us a glimpse of how the economy will do. So this is through the business outlook indicator. So the Singapore government basically, they every quarterly they will do a survey with the Singapore businesses in the service sector, and in that survey they will just collect the views of selected group of this business owner, to ask them a few questions about how they think about their businesses, how they think about the economy and such things. They will then compile these questionnaires, the results, and they will then calculate a value index based on it. So this is called the business outlook index, or also in another name for it is the service sector sentiment index. Okay, why service sector? If you look at the breakdown of the Singapore economy, we can see that the service sector actually takes up about almost 70% of the Singapore GDP, whereas the manufacturing sectors takes up the balance 30%. So service sector is a very important, very large pie of the Singapore economy. Thereby, paying attention to how the business owner feel or how the business owner assess their business and economy may give us a glimpse of how where the economy is heading on to next. So typically, these are the questions being asked to the business owner when they are collecting the surveys. So like they will ask them how they expect their industry to perform over the next 6 months, and how they think that their firm's revenue will change in the next 6 months. So they are given just three choices to choose, whether they think that they're going to go up, come down, or they think they're going to that it will stay the same. So basically, they will compile the net value by taking the up value minus off the down value. The staying the same value is just ignore, nothing has changed. So they will just pay attention to the up and minus off the down to get a net value. And then all these questions, the results will then be compiled together on some weighted formula. I'm not sure exactly what it is. And they will then come up with the service sector sentiment index. So when the index is in the positive region, it means that generally the businesses are feeling optimistic. When it is in the negative region, it means that they are feeling generally being pessimistic about the state of the countries or state of the economy, or the state of the businesses, the state of the industry that they are in. Right, but interestingly, the best way of using this in the index is actually to be contrarian about it. What do I mean by that? Okay, so again, to be able to use this data well, properly, we want to normalize it, because you can see that this data is just very choppy, going up and down like all over the places. So it's of not much use, the raw data by itself. But when we are able to normalize it, meaning that we're able to form an average out of it, we are then able to pick up the peak and the bottom. The peak meaning that the point in time whereby the businesses of being questioned are the most optimistic. The bottom meaning that they are the least optimistic, right? So, and by laying them side by side, this index side by side, together with the Straits Times index, the orange being the service sector sentiment index being normalized, the black being the index for the Straits Times index, you can see that whenever the businesses are the most pessimistic, right, is when it's at the bottom. There's also a period of time whereby we have to buy the stock. We have to invest into the stocks in the Straits Times index, because this is a period of time whereby the index will then start doing well, start doing better over the next 6 months or over the next 12 months, right? Similarly over here, most pessimistic, then you'll go up, right? So same as the leading indicator, right? This index, I find it most useful, right, whenever it's at the most pessimistic value. When they are the most optimistic, it is less consistent. The result is less consistent. Sometimes it works, right? The index start falling. Like over here, the Straits Times index start falling. Over here, when they're the most optimistic, the Straits Times index start falling. But over here, when they're the most optimistic, the Straits Times index just fall by a little bit. So now over here is right in the middle, neither here nor there. So at the moment, this indicator, sector sentiment index, is not giving us any useful information. We need it to be at the extreme value, whether it's on the upside or on the downside. But at the very least, what we can see is that the sentiments are improving. So whenever the sentiments are improving, so typically the Straits Times index, the stock market, also tend to be a little bit doing better whenever the index is improving. But it is of most value to us as an investor whenever it falls to the negative or the oversold region in the buy zone. Okay, so as of now, what we can see from the two indicators that we are looking at economic wise, firstly, we know that Singapore economy has been growing in general, and we know that inflation has affected our uh, uh, cost of living. So the government will likely implement policies, and this is the area that they will focus on next. Uh, and from the leading indicator alone, we can see that leading indicator is at the uh, buy zone. So which means that there will be also policy, they will focus in that to cause there to be growth in the economy. But sentiment-wise, it is a bit neither here nor there, not telling us any useful information at the moment. So what do we do next as investors? Of course, as investors, apart from knowing this generally on how the economy is doing, we can also pick stock by doing a micro analysis, by looking in, or really paying attention to how well the sector, how well the company are doing, whether by studying the financial analysis, or if you are a more short-term trader, also by using technical analysis, looking at charts, looking at the movement of the prices, because that will really give us a sense of the dynamics of the supply and demand. Whenever there is a uh, uh, demand for asset, a demand for a commodity, right? That demand higher than the supply will always push up the prices of the asset or of the commodities. So very much when we look at share investing, is the same as well. When there is lots of money chasing after a stock, the supply of the stocks, the supply of the shares is finite. So when there's more and more demand for it, right, whether be it that there's a growth potential or be it that there's some news flow that seems to imply that this share price is undervalued, so the demand will then cause the share price to go higher. So understanding this supply and demand dynamic will thus be able to help the investor to spot the stocks to invest in, also to spot the timing to invest in. So thereby I also would like to recommend or introduce another way of looking at investment analysis, and that is the smart money investment strategies. So what do I mean by that? So this chart here is a smart money chart on Sembcorp industry. So it's a weekly chart. You can see that the gray line here is the weekly price of Sembcorp Industries. So this chart shows the price movement from February 2020 until January 2024. So at that period of time, the share price of Sembcorp Industries had moved from the low of 80 cents to a high of close to $6. So that is almost a 600% return over 3.5 years. So what is the blue line? The blue line shows the smart money flow into this stock. So smart money flow, when its blue line is coming down, it shows that the smart money are selling. When the blue line is going up, it shows that the smart money is buying. And this is not a hypothetical indicator. This is actually real cash being deployed into the stock. So as I said, when there is a demand for a share, when it's demand for a stock, so the demand, when more and more demand for it, right, being shown by the rising blue price, because more and more funds are being committed into buying the share, the higher demand will then cause the share price to rise. So over the period from August 2020 to January 2024, the smart money had um, pour in almost $600 million Sing dollars into the Sembcorp industry. And this $600 million being used to buy up the share price over the 3.5 years, thereby caused the share price to rise sixfold as well. So who are the smart money? The smart money are typically the professional traders, the fund managers, the institutional investors, or like hedge funds, or like the banks, who or people who basically do this for a living. They invest shares full time and this is their job. Their job is to look for a company to invest in. Their job is to grow the wealth of the investor that they are investing the funds for, right? So the smart money are people who they don't um, buy based on hearsay, buy based on rumors, buy based on news flow, but they buy or invest a stock or they sell a stock whenever there is policies or there is a general trend in the market that may then offer the opportunity for the stock to go higher, or it may then cause a restriction to the share price and cause it to go lower. And what really is a smart money flow? Okay, in this globalized world, um, most investors don't just invest in a single geographical location, right? The international funds are like flowing all over the world, and of course, the technology that we are in now has caused there to be an ease of it in moving funds around. And this flow of funds, just like how water will flow, right, it will flow to the place with the least resistance. So they will flow to the sector, flow to the countries, flow to the stocks that offers them the least resistance, that offers them the higher chance of a higher return. So this flow of fund can be caused by factors such as economic forces, like the fiscal policies, the monetary policies being set by the government, being set by the central banks. So, of course, this recent times since 2020 and now, we can see this firsthand and how the COVID-19 will cause the government to hand out cash to the citizens, and that in turn caused the share price to goes up. How lowering the interest rate affects inflation and subsequently cause the central bank having to raise the interest rate sharp, which then affects the flow of funds out of stocks and into other assets class. And then now, as the inflation is being more or less neutralized, then we can see more and more funds flowing to the stocks again. Geopolitical forces like uh, the conflicts we see between US and China trade war, the real war that is happening between Russia and Ukraine, as well as the battles are being fought by the Israel and Hamas, and now also Iran being pulled into the fray. So all these geopolitical events will also cause the smart investors to choose where they will want to deploy their funds into. Technological trends as well. So uh, basically, for most part of this year, I've been sharing my clients about the idea of investing into Malaysian shares, and this is partly due to the technological trend, which is now, of course, the inward is artificial intelligence. Of course, there isn't any high-end chip making sector in Malaysia, but this artificial intelligence, um, in order to deploy it well, in order to train this the AI, the computer into solving problems, into learning and developing, they need data centers. And Malaysia, in the sense, offer a natural source. They have the land, they have the spare capacity to build up, and they have a relatively well-trained population to be able to work in all these AI data centers sectors companies. So these technical trends will then offer an opportunities, and you will see that the funds, the money flow will basically flow into area whereby there is technological growth. And of course, beyond just these macro reasons, funds will also flow into companies that offers the best valuation, the best growth, and the best opportunities. So, how do we then use this information on the money flow index to identify potential stocks to invest in? Okay, I'm going to go through three examples of Singapore shares examples. The first one is SATS. SATS, as we all know, is a ground handling company in the Singapore Changi Airport. So basically, about 2 years ago, SATS actually announced that they're going to buy up the world's largest cargo handler, WFS, for 1.64 billion. So this company is almost the same size as SATS at the point in time. So which means that SATS have to take on huge amount of debt in order to buy and also to integrate this company into their own. So we all know, of course, in hindsight, that this is a bad news, right? Since the announcement, the share price of SATS has fallen from the near $4 to a low of almost $2.40. So in September 2023, that's when the share price, early this year, that's when the share price hit almost a low price of $2.40. So interestingly, I want you to pay attention to the blue line, which is what the smart money had done, right, over this period of time. So since May 2022, smart money, we can see, started selling, right? So they maybe through the analysis, right, some of them knew about this deal and they have started selling earlier, but definitely subsequently, as the news become announced and everybody knows about it, so we see that the selling intensified, right? Smart money started selling them, right? Some of them maybe they sell at a loss. Okay, whenever I mention smart money, I sort of treat them as one entity, but smart money are actually composed of many different professional investors or financial institutions. So some of them are definitely smarter than the others, and some of them are probably be able to make money out of deals, and while some are not. But nevertheless, their combined actions into a particular stock or into a particular sector will very much cause the share price to move in certain direction, will cause the share price, will exert certain pressure on the share price, or will then be able to lift up the share price as well through their buying actions as well. So since May, we can see that the blue line is coming down, and the blue line continue coming down only until September 2023, whereby it sort of form a base and then it start turning up, right? Start turning up earlier this year. So sometime earlier this year, right, the smart money started buying on SATS. Okay, so this chart is a continuation from September 23 when they started buying until now. So we can see that over this period of time, right, no major news are going on for SATS as apart from that they have integrated, they have bought up, completed the deal on WFS, and also the general earnings reporting, right? So you can see that the smart money started buying from September 2023, and then somewhere in this January 2024, January this year, they uh, started selling again, right, until June 2024, right? But pay attention to this because interestingly, during this period of time, the share price of SATS has gone up from a low of 240 up to the high of 290. And when the these smart investors started selling, the share price dropped back to 240. But when the share price dropped back to 240, which is a low that it picked up from, the selling of the smart money is actually not as intensive, right? The blue line did not go back to the low here. In fact, it was a little bit higher and then it started buying. So the signal comes for us, for myself, who's paying attention to what the smart money is doing, is somewhere in June, whereby the smart money buying up pretty aggressively, right? Firstly, we can see that it's a sharp rise. Secondly, the sharp rise has caused it to breach this important resistance level here. So for the smart money chart, we very much can use our technical analysis techniques to try to understand it and also to try to spot out for the entry signal. So since then, right, the smart money have been consistently buying into sets. And every time you notice that on the share price that there's a correction in the share price of sets, there's a correction also recently, right, in July until mid of this month, right? The smart money continue buying up sets, right? Thereby showing the bullishness that they have on the company, on the stock, on the business, and soon after the share price finish its correction and start trending higher. Of course, if you follow the share price of SATS, you know that now SATS is trading close to $3.60 something or $3.70 today, right? So, of course, on then we know news-wise on the August 20, SATS announced that they have reversed into profit for first quarter 2025, and revenue was up 15.5% year on year. So if you are an investor who just trade following news, then definitely you will have to buy the share price of SATS much later. August 20, that's when it's trading almost close to $3.50. So, but for those who follow what the smart money is doing, we're able to pick up buying activity much earlier, right? Much earlier when the share price is trading below $3. Okay, next example we're going to look at is Singtel. Okay, uh, sometime in March this year, right? Singtel HOTS trading, right? Typically, Singtel is more or less boring stocks who trades in a certain range and more downside than upside, right? For the past maybe donkey years. So, but sometimes in March this year, there's some excitement in the share price of Singtel that caused it to spike up, right? About 10 to 20% within a short period of time. So then subsequently it's followed by the halting of the trading of Singtel, and we then learned that there's a rumor going on that Singtel may be selling their Optus shares, the telco company that you own that is listed and operated in Australia. Of course, Singtel subsequently comes out to debunk the report and says that that's not true, right? Then, okay, so this is the chart that we see in mid March. There's a spike up in the price of Singtel. There's some activities also from the smart money, but then after Singtel debunk it, say that it's not true, then the share price has fall back to the old low before the announcement of the rumors or the news, right? So similarly for the smart money, we see that there has been some selling. But same as the SAT situation, the selling is not as intensive, right? We see that the Singtel, the smart money actually did not sell the Singtel stock back to mid-March level, right? And subsequently, from May onwards, we see that the smart money started buying Singtel and buying up quite aggressively, right? Even until now. And then we all, of course, we know from this news that there's a couple of reasons why the Singtel share price has gone up, and that's firstly during their uh, quarter announcement, the Singtel management announced that they're going to have a change in their dividend payout policy, and the dividend is risen up by almost 52% from last year. So that, of course, for income investor, that is good news, thereby causing there to be um, higher demand for the stock itself. And secondly, of course, Singtel also announced that on the 21st of June that they are tying up with Telecom Malaysia to develop these data centers in Malaysia. And these data centers, they say they will be AI ready. So basically setting up in Johor Bahru. We all know that AI is the buzzword now. And certainly Singtel has technological capability of doing that. And as I mentioned, Malaysia as a country as a whole does has the capacity to offer the land, the electrical power, the water that is needed, the resources that is needed for the building and management of the data centers. So this is good news because for Singtel, this is an area of growth, the next growth phase that they can possibly go to if they manage to kick it off and make this into a major part of their business segment. So next is a little bit of a negative example, or rather example on stock to avoid by paying attention to what the smart money is doing. So we do that by looking at city developments. So city developments is of course real estate developer in Singapore. So this chart here shows the uh, money price chart of city development together with a couple of its financial indicators. So typically for real estate companies, uh, investor will pay attention to the price to book value, right? So because the book value basically shows the value of the company when we are able to sell off all its assets and pay up all its debt. So for a property developer like City Development, it owns a lot of property, a lot of land. So these are all hard assets, and the lands they own are lands in Singapore mostly. So which we know that in a scarce uh, land Singapore, whereby in Singapore, where the land is scarce. So the value of the land, the value of the property of these assets tends to be pretty much stable and or more or less on an upward trajectory. So by buying real estate company at a very low price to book value, you are actually buying them at a uh, below the intrinsic value of the stock of the company itself. So typically for a real estate companies such as City Development, a PB ratio of close to zero point 0.5 is considered pretty deep value. And we can see that whenever the PB ratio falls to zero point 0.6 times historically, right, you will always followed by a rise in the share price for city development. So another metrics to pay attention to is the dividend yield. right? Because a lot of these companies, they pay out pretty consistent dividends. So for city development, currently the dividend yield is about 3.45%. And on previous year, the dividend yield was about 14%. So you can see that for investors who pay attention to this price to book value, firstly buying it at a book value of close to zero point 0.6 or even below zero point 0.6 times, and when it has previously pay up a pretty good dividend, so may give you an indication that the company is doing well. But um, we if we dig a little bit deeper, we can see that the previous years, the dividends, the good dividends yield is really because of a one-time uh, surprise distribution of the CDR Hospitality Trust that the company gave up to its shareholders. So this is likely not able to continue. They probably not be giving this out every year. So this 14% dividend yield for the previous year is actually something that's not attainable on a yearly basis. But even then, price to book value of close to zero point 0.5 times as of now is actually a pretty attractive proposition to look into city development, right? However, but when we look at the smart money, what is the smart money doing? Right, we can see that since 2022, smart money are actually selling, right, the stock, right, until now. So no matter how attractive the valuation is, this is really a cause of concern, and we can see that the share price is falling, right, together with the smart money selling. So even as investors, even after we do our analysis based on the financial analysis, even after we check out the uh, charts, technical analysis, and we see that a lot of these indicators are showing that it is oversold, and yet I would still advise that you'll be good to also pay attention to what the smart money is doing, because they are the one that will basically drive the share price due to the demand and supply factor, right? When smart money is selling, so there are more and more supply entering into the market, right? Because of the shares that they are selling, right? When the smart money is buying, then there are more and more demand entering the market because of the shares that they are buying up. So meaning that less and less supply outside when this smart money is buying the share. So definitely having the smart money buying is a much better time or period to look into buying the share than to buy in when they are selling. So at the moment, I would actually advise staying out. So one analogy I like to use when using a smart money chart is that I tend to treat it like, the Google Map. Okay, for example, I travel from home to office almost every day, right? So very familiar with the road, very familiar where to turn. Without using a map, I can I can travel to and fro, right? But the map is still useful because the map tells me whether there's a jam or not jam. So if there's a heavy jam, right, in road A, then I can actually choose to use a road B whereby there's not much jam, right? So I can still arrive at my destination much earlier than if I were to continue using the road that I'm very familiar with. So so this smart money is just like Google Map, right? So even though after doing all our analysis work, we know the stock is a good investment, but knowing when to buy uh, by following what the smart money chart is telling us also is an indication that can help us avoid entering too early, right? So that we can avoid a longer waiting time to wait for the stock to get back around, right? So basically for myself, as I mentioned, I service my clients through who are trading in various products such as stocks, futures, and forex. And on a weekly basis, I send out this report called the Smart Money Report to my clients. So on this Smart Money Report, I will be putting up some Singapore stocks, especially the 30 STI stocks and smart money charts on these 30 stocks, so that my clients can refer to them to know what the smart monies are doing. So apart from that, I will also, for easy viewing, I will highlight the stocks that I think that the smart money is buying based on the analysis. And also, apart from Singapore stocks, I also list out this watch list for Malaysian stocks as well. On some Malaysian stocks that I follow, that I see that the smart money is buying, I also create a watch list on this weekly report, and this report will be emailed to my clients on the weekly basis. Mostly, I will email out on either Tuesday or Wednesday when I have done the analysis on all the data collected. So today, if you were interested in receiving this report from me, and you do not have a Nova account, trading account, you can scan this QR code to open the Nova stock account, and you can start receiving this weekly smart money report, and you for the over the next 12 months for free. So you can then see whether you find it useful or not. And if you find useful, then you can then decide, you can then use it to do your investment using this Nova trading account. And apart from this smart money report, in order to support my clients, to help them to get used to it, to understand it, for now until the end of the year, I'm also arranging a webinar on a monthly basis, so on Zoom. So I typically hold this webinar on the last Thursday of the month. So the next webinar will be held on the 29th of August, this Thursday, and the following one on the 26th of September, which is a Thursday, last Thursday of September. So on this webinar, I will be sharing examples on how I use the Smart Money Report, and also some recent stock market examples and stock market movement. And apart from these services, my clients can also subscribe to my WhatsApp services as listed down here, depending on the products that they are interested to trade in. Okay, this is my contact. You can scan the QR code if you are interested to register for a one-on-one coaching session with me. You can scan the QR code and fill your particulars over there. Okay, so now for the Q&A session, let me just see if there's any other questions. Okay, there's a question. Do you provide coaching? Yes. Whether is it free? Yes, it's free. And is there a demo account to try? Yes, we do have demo account for our Nova. So, okay, you can scan the QR code on the left here, and you can then download and to apply for our Nova demo account. And you can scan this QR code here if you want to register for a one-on-one coaching session with me. Okay, let me see if there's any more questions. If you have questions, feel free to type them into the question box. Okay, there's one question that asks, what is the minimum amount to open an account? Okay, open an account is free of charge. If you open an account, you do not see the good timing to trade, to invest now, don't do anything. There's absolutely no fee for opening an account. There's no requirement for any minimum deposit for opening a Nova trading account. Okay, so that's all we have for you today. Thank you so much for being a wonderful audience for tonight's webinar. A link to the recording of this webinar will be made available in our follow-up email tomorrow. If you have any question on the webinar or on this, what our services are, or if you would like to get started you can simply reply to our email and we will get in touch with you. This is Eric Lee signing off, wishing you great success in your investment journey. Good night.